Question 1. Scenario-based. Mr. Simmons, an underwriting manager at a Texas-based insurance company, is considering a reinsurance arrangement to mitigate the risks associated with a portfolio heavily exposed to hurricane-related losses. He proposes an excessive loss XL reinsurance contract. The reinsurer, however, insists on applying an aggregate limit to the coverage. What should Mr. Simmons consider as the most implication of this aggregate limit in his decision-making? A. The reinsurer's liability will only apply after multiple small losses exceed the ceding company's retention level. B. The reinsurer will not cover any losses once the total claims paid reach the aggregate limit, regardless of individual event sizes. C. The ceding company will share losses with the reinsurer proportionally until the aggregate limit is exhausted. D. The reinsurer's liability is capped per event, but does not include an over coverage cap for the contract period. Answer. B. Explanation. An aggregate limit in an excessive loss XL reinsurance contract caps the reinsurer's liability for all losses during the contract period. This means that once the total claims amount reaches this limit, the reinsurer is no longer obligated to pay further claims, regardless of individual event sizes. Mr. Simmons must carefully analyze whether the aggregate limit adequately addresses the hurricane-related exposure for his portfolio. YA is incorrect. This describes how losses aggregate for retention but does not account for the aggregate limits effect. YC is incorrect. This refers to proportional reinsurance, which is different from XL contracts. YD is incorrect. XL contracts with aggregate limits cap the total liability. Contrary to this option's suggestion, relevant rule. Texas Insurance Code, Chapter 493, Nate Model Law on Reinsurance Agreements. Question 2. Which of the following is a key benefit of using quota share reinsurance for a ceding company? A. It minimizes the insurer's exposure to high severity losses while retaining all low severity claims. B. It provides predictable sharing of premiums and losses between the ceding company and reinsurer. C. It caps the reinsurer's liability at predetermined maximum for each catastrophic event. D. It excludes the need for detailed underwriting by the reinsurer due to proportional sharing. Answer. B. Explanation. Quota share reinsurance involves a proportional sharing of premiums and losses between the ceding company and the reinsurer. This arrangement provides predictability in both loss sharing and revenue, which is advantageous for managing consistent cash flows and risks. YA is incorrect. This describes an excessive loss XL arrangement, not quota share. YC is incorrect. While it mentions liability capping, quota does not cap a reinsurer liability. It proportionally shares all risks. YD is incorrect. Detailed underwriting is still critical in quota share contracts to assess risk appropriately. Relevant rule. Texas Insurance Code and statutory guidance for proportional reinsurance agreements. Question 3. Under Texas-specific reinsurance regulations, what is the primary requirement for an unauthorized reinsurer to transact business with a Texas-domiciled ceding company? A. They must post collateral equal to at least 50% of the total liabilities assumed. B. They must be approved by the National Association of Insurance Commissioners, NAIC. C. They must secure collateral equivalent to 100% of their liabilities to the ceding company. D. They must hold a Texas-issued certificate of authority to operate as a reinsurer. Answer. C. Explanation. Unauthorized reinsurers are required to post collateral equal to 100% of their assumed liabilities to ensure the ceding company has financial security for potential claims. This provision protects the solvency of Texas-based insurers and ensures compliance with state and NAIC regulations. YA is incorrect. The 50% collateral rule is not sufficient under Texas regulations for unauthorized reinsurers. YB is incorrect. NAIC approval does not replace Texas-specific collateral requirements. YD is incorrect. A certificate of authority is not required for unauthorized reinsurers if they meet the collateral requirement. Relevant rule. Texas Insurance Code, Chapter 493.104, a NAIC credit for reinsurance model regulation. Question 4. Scenario-based MS. Harper, the CFO of a Texas-based insurer, is negotiating a stop-loss reinsurance contract to protect against unusually high aggregate claims in a given year. During discussions, the reinsurer proposes a specific attachment point and a cap on liability. If MS. Harper agrees to the reinsurer's terms, which of the following best describes the implications of the attachment point? A. The ceding company will retain all losses up to the attachment point and the reinsurer will cover all losses above it up to the cap. B. The reinsurer will cover only individual claims exceeding the attachment point, regardless of the total aggregate claims. C. The attachment point limits the reinsurer's liability to a fixed percentage of total premiums earned by the ceding company. D. The ceding company and the reinsurer will share all losses up to the attachment point and then switch to proportional sharing. Answer A. Explanation. In stop-loss reinsurance, the attachment point represents the threshold of aggregate claims that the ceding company must retain. Once claims exceed this point, the reinsurer assumes responsibility for losses subject to a cap. This type of contract is beneficial for mitigating the financial impact of extreme loss events in a given period. YB is incorrect. Stop-loss reinsurance is based on aggregate losses. Individual claims. YC is incorrect. The attachment point is a loss threshold, not a percentage of premiums. YD is incorrect. Loss-sharing arrangements are typically not applicable to stop-loss agreements. Relevant rule: NAIC Credit for Reinsurance Model Law and Texas Insurance Code Chapter 493. Question 5. Which of the following is a critical function of the arbitration clause in reinsurance contracts? A. To define the reinsurer's maximum liability in case of catastrophic events. B. To ensure prompt resolution of disputes outside of traditional court systems. C. To specify the jurisdiction and governing law for the reinsurance agreement. D. To establish the process for renegotiating premium rates in future renewals. Answer B. Explanation. The arbitration clause in reinsurance contracts is designed to facilitate the resolution of disputes between the ceding company and the reinsurer in a more efficient and cost-effective manner than traditional litigation. Arbitration is often preferred because it is private, quicker, and involves industry experts as arbitrators. YA is incorrect. Liability definitions are addressed in other sections, such as the loss settlement clause. YC is incorrect. Governing law and jurisdiction are typically detailed in separate clauses. YD is incorrect. Premium renegotiation is not the purpose of arbitration clauses. A relevant rule: Texas Insurance Code and STAN. Reinsurance contract provisions. Question 6. What is the primary distinction between proportional and non-proportional reinsurance? A. Proportional reinsurance involves sharing premiums and losses, while non-proportional reinsurance only covers losses exceeding a predetermined threshold. B. Non-proportional reinsurance requires ceding companies to retain all premiums, but share losses equally with reinsurers. C. Proportional reinsurance covers individual large claims, while non-proportional reinsurance applies to aggregated claims. D. Non-proportional reinsurance has no retention limit, whereas proportional reinsurance includes a cap on retained losses. Answer A. Explanation. Proportional reinsurance involves sharing premiums and losses between the ceding company and reinsurer based on an agreed percentage. Non-proportional reinsurance, on the other hand, protects against large or catastrophic losses by covering only those that exceed a defined threshold, such as the retention or attachment point. YB is incorrect. Non-proportional reinsurance does not involve equal loss sharing but excess losses. YC is incorrect. Proportional reinsurance applies to all claims, not just large ones. YD is incorrect. Non-proportional contracts do include retention limits. Relevant rule: Texas Insurance Code Chapter 493 and NAIC Model Regulation. Question 7. What does the offset clause in a reinsurance agreement allow? A. The reinsurer to deny coverage for disputed claims. B. Either party to offset amounts owed against payments due. C. The ceding company to transfer risks to another reinsurer. D. The reinsurer to negotiate lower premiums. Answer B. Explanation. The offset clause permits either party to offset amounts owed under the agreement against amounts due, streamlining financial transactions. Question 8. Which of the following factors most significantly affects the pricing of catastrophe reinsurance? A. Historical loss experience in the affected region. B. The reinsurer's administrative costs. C. The ceding company's underwriting guidelines. D. Policyholder satisfaction scores for the ceding company. Answer A. Explanation. Catastrophe reinsurance pricing is heavily influenced by historical loss data as it provides a basis for estimating future risks. Actuarial models often incorporate this data alongside advanced catastrophe modeling techniques to determine appropriate premiums. YB is incorrect. Administrative costs are secondary factors in pricing. YC is incorrect. Underwriting guidelines impact primary insurance, not reinsurance pricing directly. YD is incorrect. Policyholder satisfaction scores are unrelated to catastrophe risk. Relevant rule. Texas Insurance, Chapter 493 and Actuarial Guidelines. Question 9. Under Texas regulations, what is the purpose of collateral requirements for unauthorized reinsurers? A. To ensure the reinsurer can cover claims even if it does not have a Texas Certificate of Authority. B. To increase the reinsurer's market share within the Texas insurance industry. C. To allow reinsurers to avoid complying with NAIC solvency standards. D. To enable the reinsurer to operate without financial reporting requirements. Answer. A. Explanation. Collateral requirements ensure that unauthorized reinsurers have sufficient financial security to cover claims, protecting the solvency of the ceding company. This is critical for safeguarding policyholder interests and maintaining trust in the insurance system. Why? B is incorrect. Market share growth is not the purpose of collateral requirements. Why? C is incorrect. NAIC solvency standards apply regardless of collateral. Why? Is incorrect. Financial reporting is still required. Relevant rule. Texas Insurance Code Chapter 493.104 and NAIC Guidelines. Question 10. Which of the following best describes the primary role of retrocession in the reinsurance market? A. To protect primary insurers against catastrophic losses. B. To enable reinsurers to transfer some of their risks to other reinsurers. C. To replace proportional reinsurance agreements with non-proportional alternatives. D. To ensure compliance with state-specific insurance regulations. Answer. B. Explanation. Retrocession allows reinsurers to transfer a portion of their assumed risks to other reinsurers, thereby managing their own risk exposure and ensuring adequate capital reserves. This practice is essential for maintaining stability in the reinsurance market. Why A is incorrect. Retrocession benefits reinsurers, not primary insurers. Why C is incorrect. Retrocession is not limited to replacing proportional agreements. D is incorrect. While compliance is important, it is not the primary role of retrocession. Relevant rule. Texas Insurance Code and Global Reinsurance Market Standards. Question 11. Scenario-based. An insurer in Texas has a proportional reinsurance agreement with a reinsurer where 40% of all premiums and claims are ceded. The insurer issues a policy with a $1 million coverage limit and collects $100,000 in premiums. A claim of $600,000 is filed. What amount will the reinsurer pay for this claim? A. $240,000. B. $400,000. C. $600,000. D. $360,000. Answer. A. Explanation. In a proportional reinsurance agreement, the reinsurer assumes a fixed percentage of premiums and claims. Here, the reinsurer's share is 40%. Therefore, the reinsurer pays 40% x 600, this is an equals 240,000. Question 12. Under Texas regulations, what is a key requirement for a reinsurer to qualify as authorized? A. The reinsurer must be licensed and domiciled in the state of Texas. B. The reinsurer must maintain a certificate of authority from the Texas Department of Insurance, EDI. C. The reinsurer must adhere to the NAIC Model Act but is not required to be domiciled in Texas. D. The reinsurer must demonstrate solvency but does not need to be licensed in Texas. Answer. B. Explanation. An authorized reinsurer must have a certificate of authority issued by the Texas Department of Insurance, EDI, which ensures compliance with state regulations and financial stability. Question 13. Which of the following describes a key characteristic of facultative reinsurance? A. Applies to all policies issued by the ceding company without exceptions. B. It is arranged on a case-by-case basis for specific risks. C. It automatically covers all claims above the attachment point. D. It is only available for catastrophic loss scenarios. Answer. B. Explanation. Facultative reinsurance is arranged on an individual basis for specific risks or policies, allowing the reinsurer to evaluate and decide whether to accept the risk. Question 14. Scenario-based. A Texas insurer has a surplus share reinsurance agreement with a retention limit of $300,000 and a coverage ratio of 1:3. If a policyholder files a claim of $800,000, how much will the ceding company pay? A. $300,000. B. $500,000. C. $600,000. D. $200,000. Answer. A. Explanation. The ceding company retains $300,000. The remaining $500,000 of the claim is split in a 1:3 ratio with the reinsurer, hence the ceding company pays only the retention amount. Question 15. What is the primary purpose of a reinsurance intermediary in Texas? A. To assist ceding companies in underwriting primary insurance policies. B. To negotiate and facilitate reinsurance agreements between insurers and reinsurers. C. To ensure compliance with state insurance regulations on behalf of the reinsurer. D. To assume direct financial liability for the ceding company's losses. Answer. B. Explanation. Reinsurance intermediaries act as brokers, helping ceding companies and reinsurers negotiate and finalize reinsurance agreements. Question 16. What distinguishes excessive loss reinsurance from proportional reinsurance? A. Excessive loss reinsurance applies only to catastrophic events. B. Excessive loss reinsurance covers losses above a threshold, while proportional reinsurance shares premiums and losses. C. Excessive loss reinsurance does not require a retention limit. D. Excessive loss reinsurance guarantees full coverage for all claims. Answer. B. Explanation. Excessive loss reinsurance covers losses above a predefined threshold attachment point, while proportional reinsurance involves sharing premiums and claims based on an agreed percentage. Question 17. Under Texas law, which of the following is not a common reason for the denial of credit for reinsurance? A. The reinsurer is unauthorized and fails to provide collateral. B. The reinsurance agreement lacks an insolvency clause. C. The reinsurer is domiciled in a foreign jurisdiction. D. The reinsurer fails to meet financial solvency requirements. Answer. C. Explanation. Being domiciled in a foreign jurisdiction does not inherently disqualify a reinsurer, provided they meet other regulatory requirements such as solvency and collateral provisions. Question 18. Scenario-based. A Texas insurer has a reinsurance agreement where the reinsurer's liability is capped at $1,500,000 per claim. Catastrophic event results in $3 million claim. How much will the ceding company be responsible for paying? A. $1,500,000. B. $3 million. C. $1 million. D. $1,500,000. Answer. D. Explanation. The reinsurer covers up to $1,500,000 and the ceding company is responsible for the remaining $1,500,000 of the claim. Question 19. What is the purpose of a loss occurrence clause in reinsurance contracts? A. To limit the reinsurer's liability to a specific percentage of the ceding company's claims. B. To define what constitutes single event or occurrence for claim purposes. C. To establish the reinsurer's responsibility for administrative costs. D. To require reinsurers to cover all claims filed within specific time frame. Answer. B. Explanation. A loss occurrence clause specifies how multiple losses are grouped as a single event or occurrence, impacting how reinsurance coverage applies. Question 20. Which of the following is not a typical exclusion in reinsurance contracts under Texas law? A. War and terrorism risks. B. Pollution and environmental liability. C. High-risk policies written without underwriting guidelines. D. Catastrophic losses exceeding $100 million. Answer. D. Explanation. Catastrophic losses exceeding $100 million are typically included in reinsurance agreements, especially when specific coverage for such events, e.g., catastrophe reinsurance, is purchased. Question 21. Scenario-based. A Texas ceding company retains $500,000 per risk under its quota-share reinsurance agreement and cedes 60% of all risks exceeding this amount to the reinsurer. If a loss of $800,000 occurs, how much will the ceding company pay? A. $500,000. B. $320,000. C. $200,000. D. $300,000. Answer. A. Explanation. Under the quota share agreement, the ceding company retains the first $500,000. The reinsurer pays 60% of the remaining $300,000, i.e., $180,000. The ceding company's total liability is $500,000, regardless of the loss amount above the retention. Question 22. What is the primary benefit of using reinsurance for a Texas insurer? A. Reducing administrative costs for claims processing. B. Eliminating the need to maintain reserves. C. Limiting exposure to large or catastrophic losses. D. Increasing underwriting requirements for policyholders. Answer C. Explanation. Reinsurance allows insurers to mitigate their exposure to significant losses, improving financial stability and enabling them to underwrite more policies. Question 23. What distinguishes treaty reinsurance from facultative reinsurance? A. Treaty reinsurance applies only to catastrophic risks. B. Treaty reinsurance covers a portfolio of risks automatically, while facultative reinsurance is case by case. C. Treaty reinsurance requires reinsurers to approve each risk individually. D. Facultative reinsurance is always more expensive than treaty reinsurance. Answer B. Explanation. Treaty reinsurance automatically applies to all risks covered under the agreement, whereas facultative reinsurance is arranged individually for specific risks. Question 24. Under Texas law, when can a ceding company take credit for reinsurance ceded to an unauthorized reinsurer? A. When the reinsurer agrees to cover catastrophic risks. B. When the unauthorized reinsurer provides collateral meeting state requirements. C. When the agreement includes a waiver of insolvency. D. When the reinsurer is located in a reciprocal state. Answer B. Explanation. Credit for reinsurance ceded to an unauthorized reinsurer is allowed if the reinsurer posts collateral, such as a letter of credit or funds in trust, to secure their obligations. Question 25. Scenario-based. An insurer in Texas purchases excessive loss reinsurance with an attachment point of $1 million. A single event causes $1,500,000 in losses. How much will the reinsurer cover? A. $500,000. B. $1 million. C. $1,500,000. D. $0. Answer A. Explanation. The reinsurer covers losses exceeding the attachment point $1 million. The reinsurer's liability is $1,500,000. 1 mil equals 500,000. Question 26. Which clause in a reinsurance agreement ensures that the reinsurer will cover obligations if the ceding company becomes insolvent? A. Insolvency clause. B. Retention clause. C. Offset clause. D. Loss occurrence clause. Answer A. Explanation. An insolvency clause requires the reinsurer to pay claims directly, even if the ceding company is insolvent, ensuring policyholder protection. Question 27. What is the primary purpose of the Texas Reinsurance Intermediary Act? A. To regulate claims handling by reinsurers. B. To establish standards for reinsurance contracts. C. To oversee the conduct and operations of reinsurance intermediaries. D. To define retention limits for Texas insurers. Answer C. Explanation. The Texas Reinsurance Intermediary Act governs the activities and responsibilities of reinsurance intermediaries to ensure fair practices and compliance with regulatory standards. Question 28. In Texas, what is the required minimum trust fund amount for an unauthorized reinsurer maintaining a trust agreement? A. $5 million. B. $10 million. C. $20 million. D. $50 million. Answer B. Explanation. An unauthorized reinsurer must maintain a trust fund of at least $10 million to qualify for credit for reinsurance under Texas law. Question 29. What is the role of an arbitration clause in a reinsurance agreement? A. To require court intervention for disputes. B. To establish a process for resolving disputes without litigation. C. To mandate the reinsurer's approval of claims. D. To waive the ceding company's right to recover losses. Answer B. Explanation. An arbitration clause specifies that disputes between the parties will be resolved through arbitration, avoiding lengthy court proceedings. Question 30. Scenario-based. A Texas insurer cedes 75% of a risk to a reinsurer under a quota-share agreement. The insured files a $400,000 claim. What amount is the reinsurer responsible for paying? A. $100,000. B. $300,000. C. $400,000. D. $75,000. Answer B. Explanation. Under a 75% quota share agreement, the reinsurer is responsible for 75% of the loss, or 0.75x 400 equals 300,000.